Well, good afternoon, everybody, and thank you very much indeed for joining us for the second in our series of offshore investing. Last time we focused on a number of the funds that we at Anchor have got in the offshore space. This time we're going to get low down and dirty and start to look at some of the underlying equities and do a deep dive into some of our preferred equities across the funds. My name is Mike Gresty, and I'm going to be driving operations today. So before we get into the companies themselves, I just wanted to give you a bit of context from a sort of overall market perspective as to where we are. And what I'm showing here is just a long run series of the S&P 500 from a valuation perspective. So this is looking at the S&P 500 price as a multiple of forward earnings. And really what I wanted to focus your attention on is how this period over the last number of years, which has obviously been a very strong period for the S&P 500, certainly been a nice one for passive investors and made the world of investing feel very simple, really. But just to highlight how this period over the last decade or so, not only have we seen reasonably good earnings growth, but a big driver of performance of the US market has been this upward re-rating. Yeah, we saw it spike up significantly in 2020 when we saw earnings collapse amidst COVID, and it does appear that it's come back. But the point being that valuations for the overall market are still very much at levels we last saw around the dot-com bubble around about 2000. And the question is, after this strong upward re-rating, what sort of returns can you expect from equities from here? And what I've shown here on this next slide is a scenario analysis, really, I guess you can call it. And what we've done is looked at, had you invested at the beginning of each month since 1990 in the S&P 500, what compound return would you have got over the subsequent 2 years? And looked at that in relation to the earnings multiple, the rating of the market when you made that initial investment. And surprise, surprise, what you see here is that the higher the valuation when you made your initial investment, the lower the projected, the return that you achieved over the subsequent 2 years. Yes, there's a lot of argument that at the moment things are very different. Interest rates are low, earnings are rebounding strongly, lots of money being thrown at the market. And as a result, it's not assured that we're going to see negative returns or anything like that. In fact, we at Anchor are still reasonably optimistic about equities. But I think the key point here is when you consider that the forward multiple on the market at the moment is over 22 times, at an index level at least, it looks as if the outlook from here is probably going to be fairly muted. And as a result, you could say the kind of easy money has probably been made from equities as a result of that steady re-rating upwards. And we think that going forward from here, it's going to require a lot more focused attention on the individual shares that you have in your portfolio and being a lot more thoughtful about that than just relying on essentially the tide to lift all boats and the overall market to carry you forward. So this is where now we're going to start to drill into some of the individual equities that we particularly like across our portfolios. This is not to suggest that these are the only companies, of course, that are in there, but I hope that it will give you a flavor of the sort of things that we look for. And I just wanted to remind you of how do we at Anchor pick shares? What are we particularly looking for in international markets? First point to make is that if you're going to put us in a box, we would see ourselves as quality growth managers as opposed to value managers. So it does mean that we're certainly not looking for cheap shares. We're typically looking for companies that compound their growth over time, high return on capital businesses. And as we said in our previous webinar, these are businesses that are not only going to outgrow their peers in better times, but we feel also have a strong moat in periods when things turn tough. They're going to survive where potentially those lower return companies run a much greater risk of going into bankruptcy, perhaps in a serious downturn. As we're investing further from home, in many cases, we rely on strong management teams with a strong track record. Where we're typically investing for South African investors, we make sure that our exposure to emerging markets is quite measured. Obviously, we have a lot of that through South African companies themselves. And we're trying to ensure we get a well-diversified spread of exposure. And often that goes hand in hand with high return on capital companies. These are often global platforms that are really delivering that return to scale. And then we consciously try to avoid replicating what you are likely to be able to get exposure to through South Africa. For example, you'll see very limited exposure to materials, and we're trying to find things that are different. So I hope as we now run through the companies and drill into what is our thesis for each of these particular companies, you're going to see a number of these themes come through. So now I'm going to hand over to the first of our panelists. That's Dave Gibb. Dave manages our worldwide flexible fund, as well as a co-manager of our global technology fund. Then over to you, Dave.
Thanks, Mike. So I'm going to talk about genome editing this afternoon. Just a few comments on the field of genome editing, and then an investment that we made in February of last year in a company that is involved in genome editing. So, I mean, I think the one thing, if you think of the revolutions that we've had in sort of new technologies, and we go back to, say, the first 50 years of the last century, Albert Einstein's work on the atom was hugely important. And understanding the potential of the atom led to, nuclear power, nuclear weapons, lasers. So, I mean, you could argue that was the first very important discovery in that period. The next 50 years, so from 1950 to 2000, the bit was probably the most important technological discovery. And from that, we had microchips and the whole, revolution in the software industry. And some people think now that for the next while, certainly from 2000 onwards, is a revolution in life sciences. And that's really about understanding the gene and the human, the mapping of the human genome, which was completed in 2003, has now potentially opened us up to enormous value creation in the life sciences category. So if we move on to the next slide, Mike, this is the sort of thing that we can now imagine. Can we cure genetic diseases? So if there's a disease that so far we can't treat, and we know which part of the genetic sequence is causing the disease, can we then go in and edit that part of the gene with a once-off sort of rectification, and then the person potentially is cured? So these are the kind of questions that we can now ask based on some of the developments that are happening now in the life sciences category. So thanks to people like, if we move to the next slide, Mike, thanks to brilliant scientists like Jennifer Doudna, these things are becoming a possibility. Now, Jennifer Doudna was inspired by Rosalind Franklin, who helped Watson and Crick, and they discovered the structure of the DNA molecule. The DNA, that's the double helix, which is the basis of our genetic material. And that was discovered in 1953. And Jennifer Doudna, when she was in grade 6, her father left a copy of the book, The Double Helix, on her bed. She was living in Hawaii and was fascinated with the natural world and the difference between all the different plant species and animal species. And she decided to become a scientist at a young age, inspired by the example of Rosalind Franklin. And a lot of her work, she focused on RNA, so ribonucleic acid, and her work. What she eventually did was she was one of the key people to discover this potential of genome editing. And what she did was she discovered how bacteria had defended themselves from viral attacks. And they'd been doing this for millions of years, the bacteria. and through a technique called CRISPR, which was a way that the bacteria would chop up the genetic material of the viral load. And if you move on to the next slide, for her efforts, she was awarded the Nobel Prize for Chemistry just late last year, for coming up with a method for genetic editing, for genome editing, and that was, according to the Nobel Institute. And she worked, with various other scientists, and she shared the prize with a French woman, Emmanuelle Charpentier. So because of this work, typically what scientists then do is, how do we now commercialize what we've discovered? We've discovered a way of editing people's genomic material. And so if you move to the next slide, the next thing was to launch a series of companies. So our journey at Anchor with genome editing started in January of last year. In fact, I was reading the FT. This was from the 7th of January, and the headline was CRISPR puts first human in-body gene editing to test. And they spoke about the 3 companies that were co-founded by the various CRISPR scientists. And Jennifer Doudna was the scientific co-founder of one of these. And you can see that Intellia Therapeutics is the company listed in the middle at the top. And so she, if you just move back there, so we decided to invest in Intellia. We thought it was the best run of these new companies, pre-revenue, just an idea that they could use CRISPR to edit people's genes. So we thought, the CEO is a chap called John Leonard. They were the most ambitious of these 3 companies, and we decided to buy a stake. We paid for the bulk of our stake $11.70 in February of last year, and I'll now just go through some of what's happened since then. So the idea behind Intellia Therapeutics was to establish a platform. If you look on the left-hand side of this slide, was to establish a platform where they could insert these lipid nanoparticles into the body, which would go to the targeted area where there was a genetic disease, and where you could have a once-off treatment and cure the genetic abnormality, right? So that's the basic argument behind something like Intellia Therapeutics. The other 2 weren't trying to use systemic treatments like Intellia was. So this was a much more risky treatment. And so just over a week ago, they came out with their first clinical, some early results from their clinical trial on 6 patients. And these patients have got a genetic disease called amyloidosis. And Intellia is using a drug called NTLA 2001, which is CRISPR-based. So you have a drip that goes into your arm, and it's trying to cure a liver disease. And so after 28 days of treatment, these 6 patients showed remarkable results. That basically the targeted gene in the liver was being inactivated by the CRISPR, and effectively the cells in the liver were being cured. So these are early results. So far, we're not really seeing much in terms of negative side effects, but it's had an absolutely enormous impact on the share price. So if you move to the next slide, the share price has doubled since these preliminary results were released on the 25th of June. And it's, it moved from roughly $80 up to $160. So, our story with this company is we initially bought at $11.70, and it's moved just over a period of a year up, some 14 times up to $160. And I think the key thing for us, it's now one of our biggest holdings in the Global Technology Fund, is if you find a revolutionary technology before the value has been created, you've obviously got to look for real promise in the science, and then you invest at an appropriate size, and you wait for the technology to take its course. And that's really what we've done here. We don't have many early stage companies across our funds, but certainly in the Global Technology Fund, we are always looking for these types of opportunities. And obviously the value creation for our clients has been enormous, particularly in this last month. So that's it from me, and I'll hand back to Mike to introduce our next speaker.
Great, Dave. Thank you very much. Just before I introduce the next speaker, if I can remind you, if you do have questions, at the bottom of your screen, you will see a box where you can type in your questions. So please do that, and we will certainly come back and answer questions at the end of the presentation. Sorry, bear with me 1 second. Right, our next speaker I'm going to hand over to now is Henry Biddlecombe. Henry is also a co-manager of the Global Technology Fund. Henry's going to talk through a couple of companies that I think will certainly be much closer to home in terms of names that you'll recognize from many of your investment portfolios. So over to you, Henry.
Thanks, Mike. I've decided to spend my 10 minutes with you guys today just sharing what I think are some compelling stories from our tech fund portfolio. Often we spend a lot of time on numbers and fundamentals, but really, as an investment manager, if you can do a good job of imagining what the world will look like in just 5 years' time, well, then it's highly likely that you'll beat the market. So, a company's story is a very important part of the process. And I guess a company's story is a company's strategy as well. The first company I want to talk about is Facebook, and I've spoken a lot about it before, and I love using this slide because it's a reminder to people that Facebook isn't just Facebook anymore, right? It's Instagram, WhatsApp, and Oculus. And that's important because Facebook is busy transforming itself. It's transforming from an advertising company, a very good one, into really a business enablement platform. Now, if you think about it, Facebook always sat at the top of the sales funnel, where they would display an ad for a product, they would create demand, they would send, which would hopefully cause you to click on the ad, and it would send you to the retailer's website, and you'd hopefully buy the product. But then it made sense for them to build their infrastructure further down the value chain, to the point where you could make the purchase decision within their ecosystem. Because that would have two effects. One, it would increase the commercial value of their advertising inventory or space because their conversion rates would be higher. And secondly, it would allow them to take a margin on the product, of course, when you choose to buy it. So the retail landscape is changing, right? And I always use the example of a person needing a new pair of sunglasses. So when you break yours, you think to yourself, right, the next time I'm at the shops, I'm going to have to go to the sunglass shop and find a pair. Or today you might go onto Amazon's website when you've got time and start looking for a pair. But now imagine that you're on social media and you see a photo of a person wearing a great pair of Ray-Bans. And right there and then it gives you the option to buy them. Okay, that means that Ray-Ban earned that sale the day they uploaded that photograph. The other brands never stood a chance. And so it's basically an arms race for retailers to reach you first when your propensity to spend is the highest. And who makes the most money in an arms race? Well, it's the guy selling the guns, isn't it? And I think Facebook are the guys selling the guns into this particular arms race. And then secondly, what makes a customer valuable? Well, certainly a once-off purchase is a good start, but a repeat customer is what every business is after. And it's that after-sales experience that's all important. And Facebook are helping businesses to move that after-sales experience into the virtual world via WhatsApp so that you can answer a customer's query when it's convenient for them. So on WhatsApp, they can send you a query at 2 in the morning, and using an AI engine, they can respond to that query immediately. So you remove the friction in the process, and your customer is more likely to come back to you for another purchase. And then thirdly, you've got Oculus, which admittedly is more of a futuristic bet, but I think it's a category that will be big in the future, that is augmented reality. And it's really where you're walking down the street, whether it's via your sunglasses or your reading glasses or your cell phone, it'll superimpose the digital world on the physical world. And that might seem a little alien-like at this point in time, but so did a lot of the technology that we take for granted today, not so many years ago. The other the next slide, please, Mike. But all of this sounds a little ethereal, and of course, one wonders how they're practically going to go about implementing this. Well, the other day, Facebook actually sent out an email to a lot of their larger advertisers, launching what they call the Facebook Business Solutions Accelerator program. And any of you who've been involved in IT implementations at work will recognize some of the terminology on this slide: conversions, APIs, business extensions, and business apps. These are the things that the program spoke about. But basically, it's a 12-week-long intensive program where Facebook are assigning a technical expert to your staff to help you integrate your business's processes into their platforms. So not only is the potential there, but they are busy implementing these kind of this functionality at a ground level of late. And the analogy I always use is that I think Facebook commerce is going to develop much like a sinkhole does under physical retail, where it takes years and years to form, but you don't know it's there up until it's too late and it envelops everything. Next slide, please, Mike. And yet, despite all of this potential, I don't think it's reflected in the stock's current valuation. So it's currently trading at around 25 times forward earnings, certainly not expensive in absolute terms or relative to the market. But if you look at consensus earnings estimates, you can see that there's a very powerful earnings multiple unwind over the next 2 years, where you really are paying an attractive multiple just 2 years out of less than 20 times earnings. So I'm really excited about the prospects for Facebook. Next slide, please, Mike. The next slide deals with a concept that's very relevant to a stock that we recently included in our high street portfolio, and that is Netflix. And that's the concept of the customer churn rate. But it also has broad application to a number of the technology businesses that use a customer subscription model. And I'm going to explain a little bit about why. But first, I just want to highlight to you that Netflix is really the segment leader in terms of churn rates. Right now, their subscriber churn rate is actually sitting at below 3%. Which really leads the pack, as you can see. But I want to show you how the math works to explain why this is significant. Next slide, please, Mike. So when we talk about subscription services like Netflix, you'll find that people always center on the average dollar spend per user, which of course is an important metric, right? That's how much they're spending with you every month. But what's far more important is how long they stay with you, right? Because that informs how much money you're going to make off of them over their life as a customer of your business. Now, if you look at Apple, for example, if your average customer is spending $10 with you and their churn rate is currently 15.5%, that's the actual number, you're losing on average a subscriber, the same subscriber every 6 months. So their lifetime value sits at around $64. But if you look at Netflix, that same customer paying the same $10 per month to Netflix is actually worth around 5 times more to the business because their churn rate is so much lower. Netflix are only losing a subscriber after around 40 months on average. So this is a really powerful lever that technology businesses can pull. And by reducing the churn rate, you can add a tremendous amount of value to your firm. And there are a number of other businesses as well, which I think stand to improve their churn rates from here. Disney Plus is one of them. Apple Plus is another one. Amazon Prime. These are all counters that we own in our fund. And I think it's a metric that you need to watch as an investor. Next slide, please, Mike. Just lastly on Netflix, if you have a look at the forward rating, at least how the business is priced relative to profits over the next 12 months, it's probably the most reasonably valued that it's been in the last 10 years. So again, that's one of the reasons why we're quite excited about Netflix from here. Next slide, please, Mike. The last business that we're talking about is Spotify. And I'm going to explain why I'm excited about it. So if you have a look at Netflix, this is a company worth almost $250 billion. When we think streaming, we all think video, we all think movies and series, but we forget about audio, especially as South Africans, because audio isn't a big category for us. But if you look overseas in Europe or in the States, people spend a lot of time on public transport. They used to spend a lot of time in offices as well. So a lot of your downtime is spent with earphones in your ears, and that's valuable time to advertisers. And it's a space that Spotify are making a strong play for. And I actually think that the potential of this category is as big as the video on demand category. And that's why I think Spotify's current valuation of $50 billion leaves a lot of money on the table for investors. Next slide, please, Mike. But Spotify is evolving as well. It's not just a music business anymore. I mean, you guys would have seen that they're making a meaningful play for the podcasting space. I'm sure that a lot of you have started to listen to podcasts. A lot of your friends would be listening to podcasts, and the nature of podcasts is evolving as well. And it's an area that Spotify are pouring a lot of investment into. For example, they've added a video element to certain select podcasts, which is causing Spotify actually to look more like a TV station in your pocket. But what makes it even more intriguing, in addition to that, is the fact that this is now becoming an interactive TV station. So the host of a podcast can now do things like host a poll or take a vote if it's a sort of talk show. And that means a much more engaged audience. And what does a much more engaged audience mean for an advertising business? Well, it means a much more valuable ad inventory, which ultimately results in higher ad revenues. Next slide, please, Mike. And the reason why I think that the business is so attractive at this point, at least, is that we all know the story about how digital advertising has taken share away from print advertising over the last 10 years. But what's interesting to me is that as a category, TV advertising has actually been quite resilient. You can see that it's held around a 35% share of total ad spend for the last decade. But I think we're now at a point where something like Spotify is well positioned to start taking meaningful share away from TV. So over the next 10 years, I would expect that dark green channel to start being eroded by companies like Spotify. So again, and I don't think that potential is necessarily reflected in today's share price of around $250. Mike, that's all from me today.
Great, Henry. Thank you very much for that. Right, it's over to me now, and I'm going to just take you through two companies that are probably a little different to the ones we've just spoken to. These are more old world businesses, I guess, which under strong management that have come in more recently, we've seen these businesses really begin to transform themselves and deliver that strong history of performance that I mentioned at the beginning of the presentation. So the two companies, very different, that I'm going to speak to is firstly Moncler, which is a sort of mid-sized luxury company listed in Italy. Now, and then we'll follow that up with a discussion about Boston Scientific, a med tech company. But first of all, Moncler. So this is just a quick slide to give you some history about where Moncler has come from. Started in 1952. Probably the first important development that we need to care about was the acquisition of the brand by the guy who is now the CEO and chairman. I admit probably not ideal in terms of the way we think about corporate governance in South Africa, but Remo Ruffini took over Moncler. He was their creative director at the time and really turned this business around. It was almost bankrupt back when he acquired it. Listed on the stock exchange in Italy in 2013. We'll look at some performance statistics from it in a little bit, but essentially all through this time has delivered extremely strong compound growth without any acquisitions until very recently. One of the great things that he's introduced in the last couple of years, which he's been really lauded for, is this thing called Moncler Genius. Now, essentially, most of these apparel luxury goods players have one range that they'll issue to much fanfare once a year. What Mr. Ruffini did is he introduced this idea where they collaborate with a range of different designers and introduce ranges throughout the year on a sort of rolling basis. Now, although they don't tend to be particularly significant in an individual sense and only account for about 10% of Moncler's revenue, what it's done is it's kept the brand very much in people's minds, kept the sort of social media going. And typically you find that people coming in to see these new ranges that keep coming in don't necessarily buy those things, but they buy others. And it's given Moncler a really nice kick to revenue. Then the recent development that's just happened in the last couple of months is that Moncler has made its first acquisition. It's bought a brand called Stone Island. And the difference between Moncler and Stone Island is that Stone Island is a much younger brand. If we have a look at some of the different things that they sell, I mean, essentially Moncler is best known for these puffer jackets. That's their real iconic brand. If you've got a spare €2,500, that would put you in the hitting zone for what Moncler sells. but you can see these images here revealing a lot more about what they're trying to do with Stone Island. So it's giving them a window really into the entry level of luxury, and you can see that demonstrated by this luxury pyramid. And essentially both of these brands are still, and particularly Stone Island, still quite Europe-centric. So essentially what we see in Moncler is not only this expanding group of brands, but also a steadily internationalizing business off a much lower base than you would expect with the likes of LVMH and so on. So now just looking at performance, certainly over the last decade or so, very strong compound growth out of Moncler. And importantly, up until now, that's been completely without acquisition. It's a high return business generating returns in excess of 20%, very cash generative. And one of the things we particularly like at the moment about it is if we consider a world in which we're likely to see increasing inflation, we're looking for businesses that are best able to pass that inflation on to customers. And certainly the luxury component of the market is an area where we think they have very good pricing power. Balance sheet, very strong. They've deployed a little bit of that now in this acquisition of Stone Island, but you get a sense of just how strongly this business throws off cash. So very, very solid business. And then if we now turn to kind of what is the outlook for Moncler from here? So obviously the development, as I say, around the acquisition of Stone Island. Other things that are going on is that they're busy internalizing their e-commerce platform. This is something that up to now has been run by an organization called YNAB. And as we've seen that done initially in South Korea, we've seen a very strong pickup in sales. They've recently internalized their US operations. And the big move this year is going to be to internalize the e-commerce in Europe. Obviously, they're a very important market, as I mentioned earlier on. What we are seeing, though, is that they're also rolling out around 10 to 15 new stores. A lot of those now focused in the East and in China. And one of the things we're looking forward to is in 2022, the Olympics, the Winter Olympics are going to be hosted in China, and obviously very important for Moncler, given the nature of its product offering. And something else that we also think could give them a real boost is the return to the ski slope. So they're very much into that high-end ski wear. If you look at the valuation of Moncler, it has had a little bit of a wobbly, I must admit, in terms of its performance, as you would have expected in 2020 as a result of the initial impact of lockdowns. But as we've seen it now coming out of that, certainly the shares re-rated up quite strongly as people anticipate the strong rebound in performance, the benefit from that acquisition of Stone Island. But it is a business that we expect to continue to compound its earnings comfortably in double digits. And it's one that we took the opportunity to add to our portfolios when it took a little bit of a knock as a result of COVID. And a business that's very similar in that vein is Boston Scientific. This is a business that we had been watching for quite some time. And frankly, it appeared absolutely bulletproof. And then the hit that it took in the midst of COVID has given us an opportunity to build a stake in Boston Scientific. If we go back 10 or 12 years, Boston Scientific was a pretty stodgy, single sort of device, medical device company, focused very much around the cardiac heart area, doing things like pacemakers, defibrillators. It was quite a low growth area. And then a new CEO took over named Mike Mahoney. And what Mike has successfully done is drive a diversification for Boston Scientific, particularly moving it into what they describe as higher growth areas of medicine. So it's urology, pain management, quite a lot of single-use scopes around the gastric region. And as what we've seen with Boston Scientific as it's developed, it's now essentially a platform business in a whole lot of diversified areas of medical devices. And it's steadily adding bolt-on acquisitions, which it integrates into its business. And what you can see this has done, as I said, it moved it from a very stodgy, low-growth business. As these businesses have been added, it's moved it structurally into higher organic growth territory. They now target among the highest growth within the US-listed medical device sector. And And if you combine high single-digit revenue growth with what you've seen here, steady margin expansion, what you've seen from Boston Scientific is a business that is compounding its earnings in the mid to upper teen range. And what they're targeting over the next 10 years or so is to lift their margins to in the region of 30%. So we think that coming out of COVID, this is another business that has the ability to continue to do what it's been doing and what it's proved successful at, to deliver that compound earnings growth that we look for. So if you look at it from an earnings perspective, you've seen, or from a rating perspective, I should say, we've seen this business steadily re-rate upwards now as the market has become more confident about management's ability to deliver on what it's promised. However, you've got a business here currently on a forward multiple of around 22, 23 times that we think will continue to compound its earnings through doing exactly what it's been doing over the last decade in the mid to upper teens. So, again, a company that perhaps in an overall market that we're not terribly excited about, this is one we think will continue to compound and outperform for you. On that, I'm now going to hand over to the next in our lineup. This is Seleho Tsatsi. Seleho is also a co-manager of the Global Technology Fund, and he's going to talk to you about also a business that's not particularly well known, I think, among main investor circles, which is Constellation Software. Over to you, Seleho.
Thanks, Mike. We can go off to the first slide. Yes, as you say, Constellation it's a business that comes out of Canada, and perhaps that's part of the reason why it doesn't get the media coverage that some other parts of the market might get. But we think it's every bit as, if not more interesting than a lot of the other perhaps more well-covered businesses out there are. So you can think of Constellation as a holding company for software businesses. On the right-hand side of the slide, we have a sampling of some of the spaces or sectors in which these software businesses operate in or provide software to. And it's everything from ride sharing to insurance to rental to the court system. So it's really a smorgasbord, a variety of spaces. But what they all have in common is that they are software businesses. So they're providing software to these different sectors. And, you can suspect that that's essentially where the name came from. So it's a constellation of software businesses or software companies. If we go to the next slide, Mike, you can see that historically, Constellation has done a really fantastic, just a great job at growing their earnings over time. And that's translated into really good shareholder returns. So depending on the period that you look at, over the last 1, 3, 5, or 10 years, Constellation's generally grown their earnings at about 25 to 30% a year. And you see that in the chart on the left. That's obviously a very impressive growth rate. And that's led to very decent shareholder returns. So on the right of this slide, you can see that shareholder returns on a per annum basis have been, again, depending on the period, about 30% a year. That's obviously very attractive, but the big question now going forward is what's going to happen to that growth rate for shareholders owning the share in 2021. We think that Constellation can continue to compound earnings at a decent rate, and it's really because of the model of a software business, and certainly the fragmentation that we see in the space. So if you think about the software sector, you've got these huge companies like Adobe or Microsoft at one end, and these are just huge companies with a lot of scale. But there's this long tail of companies that are profitable, they earn very good returns on capital, but they're just never going to get to a scale of something like a Microsoft or Adobe. And it's really in this tail, that's the space in which Constellation operates in. That's the part of the market that they're looking to consolidate. So we think that over time, they'll continue to consolidate that tail and grow earnings at about 15% a year. Now, one of the concerns for a company that is very acquisitive is how are they actually funding this M&A or this growth? If you look on this slide, you can see that Constellation is not doing it through issuing shares or taking on debt. So the slide on the left shows their share count since from 2010 to 2020, so roughly the last decade. And you can see that they've kept their share count flat at about 21 million shares each year. And actually, it's not on the slide, but going back to their IPO in 2006, Constellation hasn't issued a share since they listed publicly. So we're very comfortable that they're not using a highly valued share to actually acquire these companies. And secondly, if you look on the right-hand side of this chart, you can see they're not taking on huge amounts of debt to do it either. So they had a net cash balance of about $300 million at the end of 2020. And that leaves us with a lot of comfort that this is a model that they're able to replicate going forward without running into funding issues. Now, part of the reason, sorry, Mike, we can just go back one slide. Part of the reason why they're able to do this is if you think about the model of a software company, it's one of those models where if you get it right, you tend to really get it right. And because of that, it doesn't require a lot of capital, right? Because it's software essentially. So Constellation's able to take the cash that these software companies generate, and Constellation takes that cash and they go out and use it to acquire more companies. So it's a very virtuous circle that you have going on here where internally generated cash is being used to fund this M&A rather than them going out and issuing shares or taking on debt. If we go to the next slide, thanks, Mike. Now, one of the other key considerations for an acquisitive company is who's actually heading up this team or who's managing this business. Because if you think about it, we're basically betting on management in this scenario, and we're betting on their ability to allocate capital well or to continue to allocate capital well. So we're very comfortable with Constellation's management team. We think that they're honest. We think they're able. We think they're aligned with shareholders. It's headed up by a man called Mark Leonard. He founded the business in 1995, so he's been there for about 26 years now. He continues to run the business. Importantly, we think he's aligned with shareholders, and the whole team is aligned with shareholders. Mark himself is the biggest individual shareholder. He owns about 2% of the company. He doesn't take a salary, and none of the management team have stock-based compensation. So it's an equation that we're very comfortable with. We think that given the lack of stock-based compensation, and in Mark Leonard's case specifically, his financial outcome with Constellation is going to exactly equal your financial outcome and my financial outcome in Constellation, just given their shareholding. We can go to the next slide. Thanks, Mike. If we think back to the start of this webinar and some of the points Mike made around what we look for as an investment team in a business, we think that Constellation ticks many of those boxes. Given the software model, it's capital light, as I said earlier, so very high return on capital business, returns on equity above 40, 50% consistently. It's owner managed, as I said on the last slide with Mark Leonard and his team. We think it's got a long runway for growth where they can continue to consolidate that tail in the software sector. And we also think it's attractively valued, which is very important. It's at about 23 or 24 times forward free cash flow. And so we think they can grow that number at that free cash flow at about 15% a year, so a mid-teens rate. And so this is a company within our portfolios that we continue to be very, very excited about. And that's really it on Constellation. Thank you, Mike.
Great, Seleho. Thank you very much. Right, on that, we're now going to hand over to the next on our panel. This is Ross McConnichie. Ross is an analyst who feeds ideas into our international investment team, and particularly into the high street portfolio, which we're not speaking specifically about today, but obviously we've discussed in the previous webinar. So Ross, with no further ado, over to you.
Thank you very much, Mike. I have the privilege of chatting to you about two of my favorite companies at the moment. The first being Adobe. If you don't mind changing the slide. Thank you. So Adobe takes advantage of many of the big macro trends that are going on in the world right now, namely being the age of digital and creativity, the push from paper to digital automation, the transformation of AI and machine learning, as well as the push for privacy and security of data, as well as a big push between mobile and cloud computing optionality. So please you change the slide, Mike. So most of you will know Adobe for Acrobat Reader, the PDF viewer, but really the company is a lot more than that. They are the world leaders in creative and design software, specifically in media editing, photos, Photoshop, Illustrator, and movies and things like that. But they also have a big play in document productivity. So they've got a big push from getting physical paper in the real world onto the cloud so that it's accessible around the world in a secure and safe manner. And a third big part of their business is empowering businesses to have a better online footprint. And that's through e-commerce, as well as data analytics and online advertising. Great. Let's take a look at the business drivers, Mike. So typically speaking, the business grows revenue at about 22% per year to 2020. The biggest part of their business is the Creative Cloud. That's 60% of revenue, and it's been growing at about 25% per year. The Document Cloud, which I mentioned earlier, is about 12% of the business. That's growing at 18% per year. And that Digital Experiences and Analytics is 24% of revenue. It's growing about 16% a year. Now, what's important to note is the 2020 year, where revenue was actually able to increase substantially in light of the pandemic. And that was mainly because of general businesses' push to online capital expenditure, as well as their push to put a lot of their documentation onto the cloud so all their employees can work from home in a safe and secure manner. Great. Thanks. Next slide, please, Mike. So let's take a look at the margins. So the gross profit margin of Adobe is increased slightly from 86% to 88% the last quarter. But really the fantastic improvement has been on the operating margin level, which has increased from 28% to 37% over the last few quarters. Now that's mostly because of the cost cutting associated with last year in the pandemic. A lot of staff costs and travel expenses all came to a halt. So realistically, this operating margin is a bit elevated at 37%, and realistically, it's probably in the lower 30s. Thanks, Mike. Next slide. So looking at the return on capital employed, that's also had a huge improvement over the last few years. So the business got more and more efficient every year. So going from 15% in 2016 to 23% in 2020. So it's been a really fantastic improvement. And looking at the valuation on the right-hand side, this is the price to earnings ratio of the next 12 months earnings. And you can see it's pretty elevated at 44 times. So what does this all mean? Well, you're looking at a business that's really running on all cylinders. It's got high margins, which are unlikely to improve from here. It's got a high rating, which is unlikely to re-rate from here. And it's really running efficiently on its capital. So realistically, the business is likely to grow in line with its top line growth, its revenue growth. Thanks, Mike. So just as to conclude on Adobe, why do we like it? Well, it's a software as a service business. 90% of its revenue is annuity-based. It's a fast-growing, has high-quality earnings. It has low debt levels. It's hugely innovative. As you can see on the right-hand side, each one of these little symbols is a different software application that they provide. It's got a huge and expanding global customer base. And as I mentioned in the previous slide, it's got a high and growing return on capital employed. And all these metrics are fantastic for long-term compound growth. Great. Thanks, Mike. Okay, my second business is Stryker Corp. If you don't mind moving to the next slide too. Stryker Corp is the world leading orthopedic medical devices manufacturer, and they also provide surgical equipment. So that's all the sort of peripherals and devices inside the operating theater. And within the orthopedic segment, they mostly provide like hip replacements, knee replacements, shoulder replacements, all sorts of orthopedics devices. And then in the neuro and spine, it's also related to the bones, but it's mostly to do with trauma associated with, say, the car accident, things like that. Thanks, So let's take a look at the revenue drivers. So typically the business pre-COVID-19 has been growing at about 10% per year. their medical surgery the medical surgery division is about 45% of the business, and that's been growing about 10% per year. The orthopedic side is about 35% of the business, and that's been growing about 6% per year. And the neurotech, which is the smallest part of the business at 21% of revenue, has been growing the most at 15% per year. But what's important to note is in the last financial year, we had a decline in revenue, which is the first decline in revenue in at least 10 years that this business will experience, because this is a really stable revenue grower. And that was because of COVID-19, and most of their surgeries can be considered elective, and a lot of that was put on hold during the pandemic, and a lot of them are coming back online as we speak. So we expect a lot of this revenue growth to improve going forward and fall in line with what it's done in the historic basis. Another thing that's really nice to know is most of its revenue, 74% of it, is coming from the United States, and that allows for a lot of improvement and massive growth outside of America, and that a lot can be coming from emerging markets such as China. Thanks, Mike. One thing that's really fantastic about Stryker is it really does bridge the gap between the old world of surgery and the new world. So, of course, it is a medical devices and technology business, but Stryker is at the forefront of incorporating robotic surgery in the actual workplace. And as you can see here, this robot is doing incisions on a knee replacement surgery whilst the surgeon is in the other room. So it's really a great symbiotic relationship between the surgeon and the robots and technology. So we really like the future that this company is sort of developing for itself. Thanks, Mike. So just looking at the valuation, this is the price to earnings ratio of the next 12 months. Again, it's looking quite expensive relative to history, but as what Mike alluded to in the beginning of the presentation, a lot of these shares have re-rated considerably, and it's not unlike the stock market in general. But again, it's a bit on depressed earnings because of COVID-19, and we expect the numbers to improve going forward. But bearing in mind, what does that really mean? You've got a business that is operating at probably its optimal margins. So realistically, you're probably going to grow its share price at around the top line growth of revenue, probably about 10%. So just to conclude, why we like Stryker, and that's mostly because it really takes advantage of the demographics of the world right now and the changes in aging population. As you can see, over the next few decades, there's going to be many billions of more people that are going to need these kind of surgeries like hip replacements, knee replacements. And Stryker also takes advantage of a growing emerging market middle class, and they're becoming wealthier and able to afford these surgeries. So that's fantastic for them. Another really interesting part of owning a medical devices business is it's quite a sticky business. It's quite a sticky relationship between doctors. And what I mean by that is once a doctor becomes familiar with a certain device or a certain product, they are very unlikely to switch to another device or another company. Another thing that's really interesting is that patients aren't as price sensitive to medical devices as they are with like the likes of their medication. And that's because a lot of the brunt is bared by the medical insurers. And finally, one of the great things about medical devices is they don't suffer patent cliffs like pharmaceuticals do. Great. Thank you very much, Mike. Back to you.
Thank you, Ross. That was very good. Thank you. Now we're going to change gears slightly, and just to bring us home at the end, and thank you all for your attention during this webinar, I'm going to hand over to Liam Hechter. So Liam is based in London, and Liam runs a number of our hedge funds and focuses particularly on the emerging market universe. And he's going to talk to us about a company that comes out of that world. So over to you, Liam.
Thanks, Mike. I guess taking a trip to the other side of the world now, a company that we're invested in the mandates that focus on emerging markets. So today we'll discuss the sort of Chinese healthcare market a little bit, but also more specifically to a company we're invested in there called Ping An Healthcare and Technologies, and the ticker is 1833 HK. So just in terms of creating some kind of setting the scene in terms of what the backdrop is and how it operates there. So the Chinese, the market in China for healthcare is still relatively undeveloped, and it remains a strategic national priority for the government to uplift people's lives and improve the improve the sort of life expectancy of the average Chinese citizen. And as the economy transitions into one that's sort of more based on consumption, we'll probably see more investment and emphasis being placed on healthcare. And as you can see in the graph on the right there, it's still pretty under-indexed relative to the more developed nations around the world. But at the same time, GDP per capita is probably on the same ratio as it is to the United States, in terms of being probably 2.5 times less than that. So in terms of the Chinese healthcare sector, it's still pretty much dominated by difficult to access healthcare for a lot of the citizens, particularly in the rural areas. And a lot of the time they'll go and wait in very long queues to get basic medical attention. And from our sort of analysis on the space, and we've been doing quite a lot of work over the last year and a bit, it looks like lead times can be anything from sort of 3 hours, but up to a day. And it's very difficult to determine when someone's standing in a queue if they need to speak to a specialist or how serious the condition is. And it's created a large backlog in the industry. And as you can imagine, as Ross alluded to in terms of elective procedures, there's a huge backlog of untreated people over the last year as a result of sort of lockdowns and medical resources being funneled into combating COVID and the like. So what we've seen is quite a big policy shift in China towards one of sort of deregulating a little bit quicker as a result to speed up the development of healthcare in the country. So that sort of creates this quite powerful backdrop for a company like Ping An Healthcare and Technology to operate under. And essentially the business is a telemedicine provider. I mean, that's like, if you go to the next slide, you'll see how it sort of comes about and how it fits into the ecosystem. So Ping An Insurance is the biggest insurer in the world by assets. It's a national champion in China. And within this insurance ecosystem, they've been able to incubate businesses. And for them, and it's a company that we've visited quite a few times and spoken to over the years in China. This is like a big conglomerate in China, and they've been able to work with government to develop out different avenues of development for the economy in China. And one of them has been the development of health insurance. Actually, South Africa's Discovery's got a part of that business in terms of the health insurer, the distribution business of the health insurer. And within that, they were able to also incubate a company called Ping An Good Doctor, and that is the app that people are able to access healthcare services via that Ping An has developed. And Ping An, so it's spun out of Ping An, the big insurer, and they still remain strategically tied between health insurance and then access to medical attention via the app. Mike, next slide. So in terms of what the business does, it's an interface that allows people access to speak to a medical practitioner. A lot of the time, there's an AI algorithm that can assess the seriousness of what the person needs to be seen to, and often sort of filter out the different sort of requirements that somebody would need, and it would mean that there's a lot of the backlog is relieved in the system because they then have the initial screening process taken care of. So as you can imagine, this fills quite a important sort of service to the entire healthcare system in China. They are not the only ones who do this. So they've got about 40% of the telehealth market. I mean, telehealth in general is a theme and something that's developing across the world quite rapidly. I think in the States, there's a business called Teledoc that you might have heard of, and that stock trades over in the States, the business that you can look at. And I think Ping An is quite a similar business in terms of it's an app that you can approach or go into and be able to either speak to first layer through AI or second one straight to a medical practitioner and get treated, or at least be fast-tracked into where you need to be. And through that, once you're in the ecosystem, they're able to sell you sort of pharmaceutical goods the types of things that you would buy in a typical pharmacy, whether it's prescription medication or things like non-prescription healthcare needs. So that then becomes the ancillary service that actually drives a lot of the profitability for this business. So it's an ecosystem that you subscribe to. Once you're inside it, you try and monetize it as much as possible. And at the same time, obviously fulfilling a need that society and the government is prioritizing in the country. So that sort of sets the scene of Ping An Healthcare, what it does. And if we go into the next slide, Mike, you'll see some of the numbers. So they've got 360 million registered users on the platform. Now that number is obviously staggering, but that is largely as a result of the tie-in with Ping An, the insurance company. So the insurer has created a distribution channel onto their healthcare platform. And from that, they've got about 80 million monthly active users on the platform. And of those monthly active users, only 5.5% of them are currently paying the subscription-based fee. But that number has been steadily increasing. So in 2017, it was less than 3%. And what we're sort of forecasting in terms of trying to create some expectation of future profitability for the business is that they'll get to about 100 million monthly active users by FY25, and about 10% of those are going to be paying monthly active users. And a large part of this thesis hinges on people's confidence that it works. So we've seen over the last year quite a big pickup in user adoption, and then obviously as soon as people start using it, the trust that they have in the system becomes quite self-fulfilling, and hopefully we'll see quite a big uptick in the paying users in terms of the subscription services, which is obviously quite a high multiple revenue stream. In terms of the landscape in China, Ping An is the only, Ping An Healthcare at least, is the only one of its competitors that has built its platform around healthcare. The two major competitors in the space being JD Health and Alibaba Health were built largely off their e-commerce businesses. So they started out, or their businesses have leveraged more off their e-commerce platforms around selling health, medical equipment and health healthcare products. And then they are busy backing out and building a telemedicine offering off the back of that. But what we like about Ping An Healthcare and Technology is that they prioritize for us the more important sort of grabber in terms of the ecosystem, and that's prioritizing the healthcare and medical offering. And another very, I guess, interesting dynamic is the app has also managed to create a national healthcare database that a lot of the hospitals are plugging into. So if somebody is using a hospital in one part of China, that data is then shared with potentially if they need to go and visit a hospital in another province or another part of China, their records will all be stored, and they'll be able to pick it up on one database. So once we believe that's going to create additional stickiness once you start using the platform, because you'll be in that ecosystem and there'll be less incentive for you to churn in terms of going to another provider, because they'll have all your data. So that, I guess, is one of the more interesting opportunities that we have. It kind of blends some of the older school sort of people's requirements with I guess the newer technology that's coming across and people are adopting around the world at the moment.
Great, Liam. Thank you very much for that. So that really concludes the run through on a number of the shares across our portfolios. And certainly I don't want to give the impression that that's where it ends. I must say, just listening to the various presentations, it certainly struck me that there was a significant healthcare feel around them. It certainly wasn't intended. I think it was just perhaps a bit of a subliminal nod to COVID, perhaps. But I would say that in many cases, perhaps COVID has given us an opportunity to get into a number of these really high quality businesses that we've been watching for some time, because a number of them certainly did blink in terms of their performance. Usually very, very strong performers. If I can remind you, just if you do have any questions, to please post them on the site. And if I can now just ask all the various panelists to join me, and we will start to run through a couple of the questions that are coming through. Great. All right. Well, let's kick off then. Perhaps one, Liam, while you've got the mic, so to speak. Got a question here. To what extent do you think Ping An Health is being impacted by the recent crackdown on tech from a regulatory perspective?
Thanks, Mike. It's a good question, and it's a difficult one to answer with a lot of conviction, particularly in the context of what's going on in China at the moment. I guess as a starting point, you need to look at the trend that's currently playing out within sort of the healthcare ecosystem in China, and that is one of deregulation. So they're really trying to speed up progression and progress in the space. So, for us, once you can't have total conviction in terms of there being some unexpected hawkish stance from a regulatory perspective. There's a couple of mitigating factors that probably ease our minds a little bit without getting a completely false sense of security in that. And one is definitely that the need that it is fulfilling is one that has been a priority for the government in China for a while. Logically or intuitively, it would make sense that providing better access to healthcare, and if this is something that's going to deeply benefit society, and if this is one way of doing that, particularly that first screening process to be able to identify how serious an ailment is and just basic access to medical care, that is something that we think is more than relevant enough to keep regulators necessarily at bay. But it is in a space that that is always going to have a lot of regulatory scrutiny. It's in a space where it directly impacts people's livelihoods, and I would imagine that it's built into the business model. The business was built on the fact that this is a sector that needs close attention and abuse of particularly quality medical attention, or at least have certain standards that companies need to be adhering to, is definitely always going to play a major part in terms of the investment thesis. It's something that we're just going to have to keep a very sort of close eye on, I guess.
Thank you, Liam. And while you've got the mic again, just another one coming through here. Is the Chinese culture moving to Western medicine and away from homeopathic treatments fast enough to favor healthcare shares?
Yeah, so that trend has been happening for a while, and it's difficult to once again conclude what a healthcare share is. There's always been skepticism around adopting Western medical techniques, but I think that's easing, and it's one that probably gets influenced a lot by publications from the government. So it's once again something that we're going to have to monitor very closely. Is it progressing fast enough? It'll probably progress as fast as the Chinese Communist Party wants it to. Would probably be my answer to that.
Great, Liam. Then Dave, one coming through here for you. At what price would you sell Intelia?
So it's a new category, this genetic, genome editing is brand new. And they're the first to show some kind of very positive results on this liver disease that I spoke of. So their market cap is $11 billion. So for me, it's more a question of how big should it be in our fund. But if this is just the start of CRISPR gene editing, this is going to become an enormous field. And so I don't necessarily think I'm going to sell all the shares now, because we're still waiting for first product launches. And in fact, we might look at investing in the other two as well, in Editis and CRISPR. So when it's a blue sky, brand new area, and your market cap is 11 billion, I'd be a little bit reluctant to sell all the shares yet. you could still double or triple from this level.
Great, Dave. Henry, one coming through for you. Would you be buying Netflix at these levels?
Yeah, I would. So the interesting thing about Netflix is the business has taken a long time to get to profitability. And right now, relative to profits, it's probably priced at the most reasonable level that it's been for the last 10 years. So, and I also believe that subscriber churn rate can come down further. So if they can drop it from 2.5% to 2%, that adds 20% to the value of the business. So I like it here.
Okay, great. Seleho, question coming through for you. What's the risk to Constellation Software if Mark Leonard steps down? You obviously highlighted what an important, real doyen he's been to that business over time.
Yeah, thanks, Mike. I think Mark's in his early 60s, so it is something to think about. If you look at the executive team, there's 5 members of that team. And the person with the shortest tenure started at Constellation in 2003. So, I mean, as a team, they've got quite a bit of history together. And some members of the team are a bit younger, so they're in their 50s, I believe. And so, yeah, I think we'd be pretty comfortable that team's been working together for quite a period of time, and they'll be able to continue doing what they've been doing with Mark.
Great. Thank you, Seleho. Dave, another one coming through for you here. Hi, David. Looking at CRISPR technology, do you expect resistance, i.e. in terms of adoption? I'm thinking about COVID-19 vaccine and the resistance thereof. Opinion on the vaccine.
So what is the question around the COVID vaccines?
Well, I think more around whether you see any resistance to adoption and use of the CRISPR technology.
Yeah. Well, look, I mean, I think if you're suffering from some of those rare diseases, it's a question of life and death. And so, a lot of people are desperate. So, if you've got young children and they have been affected, and parents are desperate for treatment, and obviously, initially, these things would be quite expensive treatments, but the prospect of a cure is just unbelievable, really. I mean, most people up to now, with some of these rare diseases have been on some kind of treatment which maybe prolongs life for, not very long. But the prospect of a cure, I think people will jump at those opportunities. But, if you think more around things like messenger RNA vaccinations, admittedly, these drugs have been approved much quicker than they would normally have been done because of the COVID pandemic. I mean, for example, I had my first shot on Friday, of the Pfizer, which is a messenger RNA vaccine. And it is really a question of life and death as well in the COVID situation, particularly in this country. Whereas I think in other countries where, I think in the US at the moment, 67% of adults have had some vaccination. So there are still a lot of people who potentially could become ill and die. But the vaccination rate is still relatively high there. So a lot of people are saying, well, I'm not interested in, there are a lot of anti-vaxxers out there. But I think with the Delta variant, I think what we saw in the FT this morning, I mean, there's a big percentage typically of the French population that are anti-vaxxers. But with the Delta variant, a lot of them have changed their tune. And they've said, look, I'm happy to have a vaccine now because the Delta variant seems to be easier to pick up and it's particularly lethal. So depending on the severity, I guess is my answer, Mike. If it's very severe, the potential illness, people are forced across the line and they will take, the most revolutionary treatment available.
Great. Thank you, Dave. Here's one probably coming across for all of us, and please feel free to chip in with your thoughts. Question, what's your macro view on investing in Chinese stocks regarding the unpredictability of the Chinese Communist Party? I mean, perhaps I'll just kick off with a few thoughts on that. I mean, certainly it's something that, we're yet again in that very awkward phase when risks elevated, the shares are underperforming. Certainly history has told us time and time again that these are the times that you've got to hold fast. And this is not the time to be questioning your investment thesis. That said, certainly I think something that we are very mindful of is these recurrent, can I call it left field regulatory onslaughts. And having covered this space for some time now, I can think of a number, particularly the likes of Tencent, if we think back not so long ago to the problems it had around regulation in the gaming space, for example. There it was proved that holding the line and holding fast was the right course of action. And certainly that's been our view up to this point. But we're also very mindful that certainly there does seem to be a decided shift in terms of the authoritarian nature of the Chinese Communist Party. And we're certainly looking to manage that as much as possible through limiting our exposure. It's obviously a market that has fantastic fundamental growth prospects. It's got big companies in the right sectors that tick many of our boxes. But yet it does feel like the rewards for what you're investing in seem particularly elusive at the moment. So from me, certainly the message is one of hold fast, but don't forget the feeling that you're experiencing right now. And in better times, it would be well worth just reviewing and reevaluating your exposure to that Chinese market in terms of your overall portfolio. I don't know if anyone else wants to chip in with some thoughts.
I may, if I may. So, Mike, I think you've summarized the key points exceptionally well there. If I could add anything, I would add that, don't lose sight of the fact that China is going to become the world's largest economy. The trend has been one of more accessibility from a financial service or financial markets perspective. So, they often say that Chinese give a lot and then they take back a little and then they give a lot again. So I think, if your time horizon is right and you've got a sort of appropriate allocation towards the space, I think, if you have a longer term view, you will probably find that you're going to need to devote a lot more attention to what's going on in the East in the next couple of decades than you were in the previous. It's just becoming too relevant for markets.
Yeah, the other thing to think of is, the Chinese are tightening up on the tech giants, and maybe that'll come in the West, in the next while too. So what we're seeing in China, it might be a little bit more unpredictable than we'd see in the West, but that might just be a taste of what we might see elsewhere. And it's, this thing about a lot of the tech giants and, how they deal with personal information and looking after their databases. So with Lena Khan now heading the FTC, which is one of the organizations, along with the Department of Justice, that looks at antitrust issues in the US, she's a more radical thinker. And in some ways, the FTC is, they've kind of split the roles. So the FTC looks after Facebook and which is the other one? They look after Facebook and Apple, I think, or Facebook and Amazon, and the Department of Justice is looking after Alphabet. So it might get tougher in the US too. So it might just be a taste of things to come.
Great. And then just one further one here for you, Seleho. Any thoughts on Constellation's European operations spin-off, Topicus?
Yeah, so I think we can almost think of Topicus as a mini Constellation itself. They have a very similar strategy that they're employing in Europe. And it's just really on a smaller scale. So I think they have on a revenue basis, they're about a sixth or a seventh of the size of Constellation. And Constellation continues to have a very meaningful stake in Topicus after the spin-off. So I think it's something that we're following. We followed since the or we will follow post the spin-off. But on first glance, it does appear to be interesting, given that it's a very similar setup to Constellation itself.
Great, Seleho. And then probably as we start to wrap up on the questions coming through, a question here, no exposure to semiconductor shortage, already priced in, ? So we certainly, the likes of ASML didn't make it into this particular presentation, but it's certainly a share that we hold in a number of our portfolios. But, members of the tech team, any thoughts on semis at the moment and why they didn't feature more prominently in the shares we talked about today?
I mean, I'm sure Dave wants to make a comment, but I'll make one quickly. I suppose we could have, one of the positions in our portfolio is Intel, and they're one of the few chip designers who also have manufacturing capability. And, it takes years and years to build out a fab to produce chips. So Intel are in a good position now to address the shortfall, particularly in the automotive market. And I think there's some optionality in that share price because of that. It's certainly not reflected in the share price today. You're paying sort of 12 or 13 times trailing earnings, 12 or 13 times trailing earnings for the core business. And that could well be an area of positive surprise over the next 12 to 18 months, I would think. So, yeah, that is a trend that is representative in our portfolios, actually.
Great. Thanks, Henry. All right, everybody. Well, thank you very much for your attention today. There are a couple of other questions coming through around how one gets exposure to these various companies that we've spoken about today. And just as I mentioned earlier on, I mean, there's just a kind of mind scatter, so to speak, of many of the other companies that are on our watch lists and in our portfolio. So this is by no means a suggestion that it's a very narrow picture of the type of shares we look at. There's a vast number of companies that are in there and that we're monitoring. And I see NVIDIA as one, which would also be within the semi space that we spoke about just now. And also, how does one get exposure? So here we've listed a couple of the funds that we spoke about in the previous webinar. And really it would be a case of speaking to your relationship manager and your portfolio manager to look at the various options and solutions that are available for you. I hope you've got a good flavor for how we think about shares. And I hope going away with a few ideas. As I mentioned at the very beginning, I really believe that this is going to be a time when, you're going to have to make sure that the horses in your paddock, so to speak, in terms of the shares you're invested in, are those high quality compounders that are going to carry you through what could potentially be, let's say, a more challenging time. The easy money's probably been made, and every share in your portfolio is going to have to earn its place. So I really want to thank you very much for your interest today. We'll be back in a couple of weeks' time with the next in the series of seminars on offshore investing. And just thank you to the team for your contribution today. Thank you all. See you next time.